imagine a day trader, right? They're sitting in front of one of those crazy 6-monitor setups.
Oh, yeah, the classic command center.
Exactly. And they just executed this flawless series of foreign exchange trades. The screen is flashing green. They're up like $100,000 for the week.
It's an amazing week.
Right. And the trades were perfectly legal under U.S. law, highly profitable, brilliantly executed. But according to a 1,400-year-old financial framework, that trader actually has to forfeit every single penny of that profit.
Yeah, the money is considered completely tainted.
It's just wild. It's this profound culture clash.
It really is. You have this hyper-fast, algorithm-driven world of modern proprietary trading crashing headfirst into this ancient, very uncompromising ethical rule book.
And that collision is exactly our mission for today's deep dive. I've got a stack of specialized source material today that answers a highly specific, but honestly globally relevant question.
Right, which is proprietary trading, or, what people call prop trading. Is it halal or haram? Permissible or forbidden?
Yeah. And look, whether you are a Muslim trader actively trying to align your portfolio with your faith, or you're just someone fascinated by how historical moral frameworks adapt to these incredibly complex digital systems, this deep dive is a masterclass.
It really audits the structural soul of a transaction.
Okay, let's unpack this. Because evaluating a prop firm through this lens means we basically have to throw out the standard Wall Street playbook entirely, right?
Oh, completely. You aren't just looking at the yield of a trade anymore. You need an entirely new grading rubric.
So let's do that rubric.
No.
Our sources outline 4 foundational requirements for any financial activity to be considered halal.
Right, and rather than just, listing them out like a textbook, let's imagine you're trying to build a completely compliant trading firm from scratch.
Okay, I like that. I'm building a firm.
The very first hurdle you're going to face is the absolute prohibition of a concept called riba.
Riba, which in Western finance we'd just call interest, right? Or like a predetermined return on capital.
Basically, yeah.
But explain the mechanism here. Why is charging, say, a flat 5% interest on a loan considered the ultimate deal breaker?
Well, if we connect this to the bigger picture, the prohibition of riba is really designed to force shared risk.
Shared risk, okay.
Yeah, think about a conventional banking system. A lender gives you money to start a business. If your business fails, you still owe the bank their principal, plus that guaranteed 5% interest.
Right. The bank always gets paid. They take zero operational risk.
Exactly. But the Islamic framework argues that capital itself shouldn't generate guaranteed money just by existing.
So the person holding the money can't just sit back in a risk-free ivory tower.
Right. If you want to see a return on your capital, you have to enter into a partnership. You have to share the actual risk of the enterprise. You have to get your hands dirty, financially speaking.
Capital has to facilitate actual commerce. That makes a lot of sense.
It does, and that ties directly into the second and third pillars you have to build your firm upon, which are the elimination of gharar and maisir.
Now, I'm seeing those terms in the text, but the lines between them seem, a little blurry to me. They both seem to deal with risk.
They do, but from completely different angles. So gharar translates to excessive uncertainty or ambiguity in a contract.
Like what?
Well, the classic historical example is buying the catch of a fisherman before he even casts his net into the water.
Oh, because you don't actually know what you're buying.
Exactly. The contract is inherently flawed because the object of the sale is unknown. You can't price it fairly.
So applied to modern markets, gharar would forbid buying those highly complex, opaque derivatives where nobody actually knows what the underlying value is.
Spot on. Now, maisir, on the other hand, is gambling.
Just straight up gambling.
Right. It's an activity that relies purely on chance rather than any kind of skill or underlying economic value.
Okay, let me test this to make sure I've got the mechanism right. Say I buy a blind bundle of distressed debt from a bank, and I don't know which specific mortgages are in the bundle.
Okay.
That violates gharar because the contract is ambiguous.
Yes, exactly.
But if I load up my brokerage account and just throw my entire life savings into a highly volatile meme stock right before an earnings call, just hoping the price spikes.
Yeah, that violates maisir because you're treating the stock market like a Vegas roulette wheel.
Got it. So one is a flaw in the transparency of the transaction, and the other is a flaw in the behavior and intent.
That captures the mechanical difference perfectly. And to prevent both of those flaws, the text introduces the fourth and final pillar, which is asset-backed transactions.
Meaning everything has to be real.
Yes. Every single financial dealing has to connect back to a real, tangible, economic activity. You can't just trade numbers on a screen for the sake of trading numbers on a screen.
But wait, doesn't this make modern digital trading almost impossible?
It definitely makes it harder.
I mean, we've stripped away guaranteed interest, we've banned excessive speculation, we require a tether to the physical world. A modern prop firm, where a company gives a trader a chunk of corporate capital to just sit at a computer and day trade,
Hmm.
that seems fundamentally incompatible with these rules.
And that is the central friction point our sources explore. How does a firm legally fund a trader without breaking these foundational pillars?
Right.
But the traditional solution actually maps beautifully onto the concept of a prop firm. The sources highlight this historical Islamic financial structure called mudiraba.
A profit-sharing partnership.
That's the translation, yeah.
Hmm.
In a classic mudaraba arrangement, you have two parties. One party provides 100% of the capital,
Okay.
and the other party provides the labor, the skill, and the time.
I mean, that is the literal definition of a modern prop firm.
It really is.
The firm has this massive pool of cash, and they allocate, say, $100,000 to a skilled retail trader to go execute strategies in the market.
Yeah.
And then they split the profits, usually something like 80% to the trader and 20% to the firm.
And Islamic scholars generally agree that this traditional arrangement is perfectly permissible. It passes the test.
Oh, wow.
But,
Okay.
and this is a big but, the operational rules of mudaraba are incredibly strict, especially regarding losses. Think about it. If the trader executes their strategy, but the market just turns against them and they lose $10,000 of the firm's capital, who absorbs that loss?
Well, in a standard retail prop firm, the trader usually just loses their account access, right? They don't have to repay the 10 grand out of pocket.
Right. And that is strictly required under mudaraba. The capital provider, the firm, has to absorb all financial losses.
The whole thing.
Yes, the trader loses their time, their effort, and whatever potential profit they could have made, but they cannot be held liable for the lost capital unless, they committed blatant fraud or negligence.
Man, this sounds like an incredibly risky business model for the prop firm. They put up all the money, they take all the financial risk, and just kind of hope the trader is as good as their resume claims.
Yeah, it is risky.
And this brings us to the massive structural problem in the modern industry. Firms found a way to mitigate that risk, and it completely muddies the ethical waters.
You're referring to the evaluation fee.
Yes. Here's where it gets really interesting. Modern funded programs, they don't just hand a stranger 100 grand.
No, definitely not.
The industry standard is that a trader has to first pay an upfront fee, say $500, to take a trading challenge on a simulated account.
Right.
And only if they hit a specific profit target, without breaking any drawdown rules, do they actually get access to the real capital.
It's the defining feature of the modern retail prop firm industry. And it's the exact mechanism that Sharia scholars are currently scrutinizing under a microscope.
Because, mathematically, isn't an evaluation fee basically a loophole?
How do you mean?
Well, if a firm's business model is actually just collecting millions of dollars in evaluation fees from the, 90% of traders who inevitably fail the test, that doesn't sound like a true profit-sharing partnership.
No, it doesn't.
It sounds like the firm has shifted the financial risk back onto the trader. The trader is basically paying for the privilege of working.
What's fascinating here is that the source material draws a very sharp line regarding why that fee exists. An evaluation fee can be permissible, but only if it represents the actual verifiable administrative cost of running the evaluation.
Wait. Define administrative cost in this context. Because a firm could claim literally anything is an administrative cost.
They have to prove it. A legitimate fee covers the tangible cost of providing the trader with real-time market data feeds from the exchanges, the software licensing for the platform, the basic customer service infrastructure.
Okay.
If the firm charges a $50 fee, and it costs them exactly $50 per user to provide that simulated environment, the fee is halal. It's just a simple service charge.
But consider this. What if the firm charges $500 for that exact same data feed, and then they pocket the $450 difference as pure profit when the trader fails the challenge?
Then the whole structure collapses. The source text makes it very clear that if a firm's primary revenue stream relies on harvesting fees from failing traders, rather than sharing actual profits from successful trading via mudaraba, it fails the ethical test.
It's a casino.
Yes. The firm is essentially running a casino, which violates the pillar of Macer. The trader is betting their evaluation fee against the statistical probability of passing the test.
It's an incredibly subtle distinction. but the math completely changes the moral nature of the business.
And this is precisely why the practical guidance in our sources stresses the absolute need for official Sharia advisory oversight.
You can't just self-certify.
Exactly. A prop firm cannot just stamp Islamic on their website. They need external, independent Islamic finance experts actually auditing their P&L statements to ensure those valuation fees are flat, nominal, and transparent, not just a disguised risk-shifting mechanism.
Okay, let's assume a trader finds a pristine prop firm. They've audited the fee structure, the firm genuinely shares profits and takes the losses. The corporate structure is absolutely flawless.
Okay, the ideal scenario.
We still have to move from the boardroom down to the individual trader sitting at their terminal.
Correct.
Because the sources make it clear that the specific assets the trader chooses to buy and sell can instantly make the entire operation haram, regardless of how good the firm is.
Oh, absolutely. The vehicle can be perfectly constructed, but the destination still matters.
Right.
The sources provide practical guidance on permissible assets, focusing heavily on equities, commodities, and spot currency transactions.
So let's start with equities, or, stock trading.
Yeah.
The source says this works, but it requires a strict value-based approach.
Right.
Obviously, you have to screen out companies whose core business violates Islamic law. You can't trade the stock of a brewery or a gambling syndicate or a conventional bank that profits off interest. But the text goes way deeper than just the core product of the company.
It requires evaluating the actual financial mechanics of the company itself. You're buying fractional ownership in a real entity, which satisfies the asset-backed pillar. But what if that company, say a completely benign tech company making software, what if they carry massive amounts of interest-bearing debt? Or what if they park all their excess cash in interest-bearing accounts?
Oh, then by owning their stock, you are indirectly profiting from or supporting riba.
Exactly the problem. Therefore, Islamic scholars have established specific financial ratios. A trader actually has to screen a company's debt-to-market capitalization ratio and their interest-income ratios.
Wow.
Yeah. If those numbers cross a certain threshold, it's usually around 30% for debt, the stock is strictly off limits. It requires an incredible amount of diligence from the trader. You're evaluating the moral footprint of the balance sheet, not just looking at the price chart.
I mean, that seems complex, but manageable if you have the right screening software. But I want to pivot to the second case study from our sources, which is notoriously tricky. Yes, Forex, or foreign exchange trading. Trading global currencies. The text highlights that Forex is an absolute minefield for ethical compliance because of something called swaps. Let's explain the actual mechanism here because I think it's crucial.
To understand the ethical violation, you really have to understand how a Forex trade mechanically works. When you trade a currency pair, say, buying the euro against the US dollar, you aren't just buying one thing. You're technically borrowing one currency to purchase the other.
So you borrow US dollars to buy the euros.
Yes. And because you're holding a borrowed currency, you're subject to the overnight interest rates set by the central banks of those respective countries.
Right.
If you hold that trade open past the end of the trading day, which is usually 5:00 p.m. New York time, the broker applies an overnight financing charge. You either pay interest on the currency you borrowed or you earn interest on the currency you bought, depending on the rate differential.
Okay, so if I borrow Japanese yen, which has a near zero interest rate, to buy US dollars, which has like a 5% interest rate, the broker actually pays me that difference every single night I hold the trade.
Yes, it's called the carry trade.
And it is textbook riba.
Textbook. It's predetermined, guaranteed interest generated purely by holding capital. It instantly invalidates the trade under Islamic law.
So how is a Muslim trader supposed to navigate the global currency markets at all?
Well, the primary workaround offered by the source text is using spot transactions with same-day settlement. If you open a Forex trade at 9:00 a.m. and close it at 4:00 p.m., you never cross that overnight rollover period.
Ah.
The trade settles immediately and no interest is calculated or charged.
Day trading, essentially.
Yeah.
But a lot of trading strategies require holding positions for days or weeks to capture larger market trends.
True.
And that is where the prop firm industry has stepped in to offer a solution. The Islamic account or the swap-free account, I've seen these advertised everywhere. The firm simply promises to waive the overnight interest fee. Problem solved, right?
Sure. Not at all. Our source text throws a major warning flag over these accounts.
Really?
Yeah. It points out that removing the swap creates a massive financial hole for the broker. The broker is still incurring costs from their liquidity providers when a trader holds a position overnight. The broker isn't just going to absorb that loss out of the goodness of their heart.
Right, they're a business.
Yeah,
They're going to recoup that money somewhere else. Which leads me to an analogy.
let's hear it.
Let's say an airline advertises that bags fly free to attract customers who hate baggage fees.
Hmm.
But when you look closely at the math, you realize they quietly raised the price of every single ticket by exactly $50, which is the exact cost of a checked bag.
Right.
The math is identical, they just changed the label on the receipt. Aren't prop firms doing the exact same thing with swap-free accounts?
This raises an important question, and it's the exact friction the sources want the reader to recognize. If a firm waives the overnight interest, but widens the trading spread, meaning they force you to buy at a slightly higher price and sell at a slightly lower price to make up the difference, that is heavily criticized by scholars. It's seen as a deceptive practice.
What about administration fees? Some firms say, we don't charge interest, we just charge a flat $10 administration fee for every day the trade is kept open. How is that any different?
This is where we have to look at the math again. Remember the rule about evaluation fees needing to reflect actual administrative costs?
Yes.
The same applies here. A server costs the same amount of money to store the data of a small trade as it does a massive trade. If a broker charges a flat $5 fee to keep a trade open for 3 days, regardless of whether the trade is for $1,000 or $1 million, scholars might accept that as a legitimate data storage fee.
But if that administration fee magically scales up, like if they charge $5 for a small trade, but $500 for a large trade, then the fee is tied to the size of the capital, not the cost of the administration.
And the illusion shatters. The fee is mathematically functioning exactly like interest. It's just riba hiding behind a different vocabulary word.
Sneaky.
Very. And the Sharia scholars are fully aware of this financial engineering. This is why the source material stresses that the terms can't just look good in a marketing brochure. Traders actually have to dig into the cost compensation methods. They have to audit the fine print on time limits.
Like when a firm claims to offer a swap-free account but forces the trader to close the position after 3 days. Why 3 days? Because after 3 days, the actual interest costs the broker is absorbing become too large to hide in the administrative fees.
Exactly.
You really have to be a forensic accountant of your own trading terminal.
You do, because knowledge is most valuable when it's understood and applied. If a trader just memorizes the 4 pillars without understanding how a broker might mechanically circumvent them, the knowledge is practically useless.
Yeah.
You have to verify which instruments are actually covered. A firm might offer a truly compliant swap-free account for major currency pairs, like the euro and the dollar. But if you try to trade an exotic currency, like the Turkish lira, they might quietly slip the swap fees back in because the volatility is just too high for them to absorb.
So what does this all mean? We've gone from the macro philosophy of ancient commerce to the specific revenue models of modern tech firms, all the way down to the overnight rollover fees on a Forex terminal.
It's a lot to process.
It is, but if we synthesize all these sources, the conclusion is that prop trading absolutely can be halal, but it is a delicate, continuous tightrope walk.
A walk that requires active vigilance.
It requires strict adherence to the mudaraba profit-sharing model, ensuring the firm takes the actual capital risk. It requires absolute transparency in the evaluation fees. They have to be service charges, not casino entry tickets.
Right.
It demands the careful selection of permissible assets, screening out heavily indebted companies, and executing spot transactions. And above all, it requires a trader to mathematically verify that a swap-free account isn't just disguised interest.
It proves that it is entirely possible to participate in high-speed modern financial markets without compromising core principles, provided you're willing to do the heavy lifting. The ethical framework exists. The burden is just on the user to apply it.
Ignorance of the mechanics is not an excuse.
No, it's not. And looking at this deep dive as a whole, it leaves me with a broader thought.
Good for that.
Well, the source material shows how a remarkably strict moral framework can successfully audit something as fast-paced, modern, and opaque as digital proprietary trading. I mean, they've taken rules established centuries before the invention of the computer and applied them flawlessly to fiber optic algorithms and global liquidity pools.
It really is a feat of philosophical engineering when you view it from that altitude.
It makes you wonder if global finance can be subjected to this kind of rigorous ethical auditing. What other highly modern, seemingly untamable industries could benefit from a similar framework?
Oh, interesting.
Imagine if fields like artificial intelligence development or global data brokering had to prove their fundamental ethical value before they were allowed to operate. What if an AI company had to prove their algorithm didn't rely on hidden ambiguous data harvesting?
Right.
What if a data broker had to prove their transactions were asset-backed, connecting to real human benefit rather than just hollow speculation on user behavior?
Applying that level of structural mechanical ethics to Silicon Valley, not just Wall Street. Demanding that they prove who carries the risk when an algorithm fails.
Exactly.
That's a fascinating concept to leave off on. We always want complex systems to be clean, visible, and binary. We want to look at a balance sheet or a line of code and just see profitable or functional. But the reality is that every transaction has a structural soul, and uncovering it requires asking the hardest questions about where the money is really coming from. Thanks for joining us for this deep dive. We'll catch you on the next one.